Welcome back to QHSE Talks, the space where safety is treated as a discipline of decisions, not just a list of rules. Let me ask you something before we touch a single formula. Right now, imagine you're holding $10 in your hand. That $10 is not neutral. It's not static. It's not just paper or numbers on a screen. It has immediate potential. It can be invested, it can earn interest, it can reduce future losses, or it can sit idle while time quietly works against you. And here's the part most safety professionals are never trained to see. The moment you delay action, you don't just delay safety, you create an invisible cost. That cost is called lost opportunity. And understanding that invisible cost is exactly what Chapter 20, Engineering Economics, is about. Because in the real world, safety does not compete with hazards. It competes with other projects. It competes with production upgrades, with IT systems, with expansion plans, with marketing budgets. Every safety decision you make lives inside a financial ecosystem, whether you acknowledge it or not. This is why Chapter 20 is not extra knowledge, it is mandatory knowledge, and the CSP exam makes that crystal clear. Under CSP11, Domain 2, Program Management, Topic 11 requires you to apply budgeting, finance, and economic analysis techniques, not philosophically, operationally. This chapter gives you the technical foundation, simple interest, compound interest, future value, and the reality that money generates money. $1 today is not the same as $1 5 years from now, and if you can't explain that, your safety proposal is already at a disadvantage. But it doesn't stop there. Under CSP11, Domain 3, Risk Management, Topics 5 and 6 demand that you understand the costs and benefits of risk decisions and the financial mechanics behind risk transfer and insurance. Chapter 20 shows you how to calculate the present worth of future savings, like avoided injuries, reduced downtime, or prevented fires, and how long it takes for a safety investment to pay for itself. This is where safety stops being reactive and becomes strategic. Because at some point in your career, someone will slide a spreadsheet across the table and say, "This is the budget. Make it work." You might be managing one site or 8. You might be justifying a $5,000 control or a $300,000 capital upgrade tied to NFPA compliance. And in that moment, no one will ask you if the control is a good idea. They'll ask something far more dangerous. Is it worth it? And that question cannot be answered with principles alone. It must be answered with engineering economics. Which brings us to the pivot point of this chapter and the shift in how you must see your role as a safety professional.
And this is exactly why this discipline is mandatory for you now. You don't just manage risk, you manage capital. You might be asked to allocate a central safety budget across, say, 8 different facilities. Which one gets the funds first? Or maybe you're requesting $30,000 for a sophisticated new computer-based training program. These are resource allocation problems.
And the language of resource allocation is financial.
Exactly.
Precisely. The sources are very clear on this. Safety is functionally a core business unit. Safety managers are now frequently asked to justify expenditures, new equipment, training, process refits in rigorous economic terms. And while the ethical justification of preventing harm, that remains paramount.
Of course.
Financial considerations are the integral foundation of any major executive decision-making process. Understanding present and future value, interest, and complex payment structures is no longer optional. It's core to getting your recommendations approved.
Okay, so let's start with the basics, because before we can even talk about the value of future savings, we have to talk about the cost of borrowing. If a company needs to finance a major safety project, let's say implementing new automated systems to refit an old processing line, they typically take out a loan. And that loan comes with a price tag, interest.
We begin with simple interest, which is really the easiest entry point into understanding this cost of money. Simple interest is straightforward because the interest is charged only on the initial amount borrowed,
which we call the principal amount.
Right. It completely ignores any accumulated interest over the life of the loan.
So let's nail down the formula from the source material. It gives us a great baseline. Simple interest, which is I, is calculated by multiplying the principal, P, by the number of years, N, and the interest rate, I.
So I equals PNI.
Let's run that practical example the source provides. Imagine your company needs to finance that processing line refit we mentioned. It's going to cost $50,000. They secure a loan with an annual interest rate of 6%, and they plan to repay it in a lump sum after 3 years.
Okay, so we plug those numbers directly into our simple interest equation. The interest calculation is I equals $50,000.
That's P.
Times 3 years, that's N.
Right.
Times 0.06, which is our interest rate, I.
Okay, so running the numbers, that gives us an interest amount of $9,000. Now, that's $9,000 that didn't go toward purchasing equipment or training or staffing. It went purely to the lender for the privilege of using their capital for 3 years.
And the strategic takeaway here for you, the safety professional, is critical. You requested a $50,000 project because that's what the vendor quote said. But the total project cost to the business, if it's financed this way, is $50,000 in principal plus $9,000 in interest.
Totaling $59,000.
$59,000.
But wait, a $9,000 difference is pretty significant. Why does the safety manager need to know that? Isn't that the CFO's job?
It absolutely is the CFO's job to manage the debt, but the safety manager has to be proactive. Think about it. If you submit a $50,000 request and the finance team goes and processes the loan, they see the $59,000 commitment. If you haven't proactively communicated that the true economic cost will include financing, your credibility suffers a bit. By including the estimated financing cost, even if simple interest is just an approximation, you show financial acumen. You show that you understand the full budgetary impact.
So you're managing expectations and speaking their language. It helps avoid that budget variance shock later on. That makes perfect sense. But as you mentioned, simple interest is, well, it's rarely used for major commercial loans.
That's correct. What's fascinating here is that while simple interest is easy to get your head around, the vast majority of real-world debt and investment operates using the next concept, compound interest. This is the financial engine of the modern world.
Okay, so here's where it gets really interesting and significantly more complex for us non-finance professionals. Compound interest is what most lenders use, and it dramatically changes the trajectory of debt or an investment. It adds a kind of exponential curve.
The definition of compounding is that interest is charged not only on the original principal amount, but also on any accumulated interest. Think of it like a financial snowball rolling downhill. That already accumulated interest, in turn, begins to generate its own interest.
Which accelerates the growth of the debt.
Or the investment. It works both ways.
Okay, let's visualize that concept. The sources give a clear mental model. Let's imagine a smaller $10,000 loan charged at 5% interest, but it's compounded monthly.
Okay, so at the end of the first month, interest is calculated on that $10,000 principal, which adds a certain amount. The loan balance is now, let's say, $10,500.
But then, and this is the key, for the calculation at the end of the second month, the interest rate is applied to the new balance, the $10,500, not the original $10,000.
Right. So the interest you pay in month 2 is slightly higher than in month 1, and the resulting balance escalates even faster. This is that key insight. Interest, earning interest.
So the frequency matters a lot.
The compounding frequency is a key variable. We call it N. If a loan is compounded annually, N is 1. If it's monthly, like in your example, N is 12. If it's daily, N is 365. The more frequently it compounds, the faster the balance grows.
And since we need to understand the math behind this, we have to introduce the full compound interest formula. The sources note this detailed version is more for understanding than for, say, a standard safety exam, but it's essential for comprehension.
The formula is F equals P times, in parentheses, 1 plus I over N, all raised to the power of NT.
Let's break those variables down so you can internalize what they mean in a real-world scenario. F is the future value.
What you'll owe at the end.
P is the initial present value or principal. I is the stated annual interest rate. And here's the crucial part, that I over N term calculates the interest rate per compounding period.
And the exponent, N times T, calculates the total number of periods over the life of the loan.
Okay, let's apply this to a concrete example. Show how that frequency changes the final cost. We borrow $10,000 and the lender charges a 3% interest rate. But this loan is compounded semi-annually.
So N equals 2, and the term is 3 years, so T equals 3.
Okay, so we plug those figures in. F equals $10,000 times, in parenthesis, 1 plus 0.03 divided by 2.
All raised to the power of 2 times 3. And you're right to emphasize that exponent. 2 times 3 means the interest will be calculated 6 separate times over those 3 years.
Right, so that simplifies to F equals $10,000 times 1.015 to the 6th power.
And the final result, the total repayment required at the end of 3 years, is F equals $10,934.34.
So the total interest paid is $934.34. Now, if we had used simple interest for that same loan, the interest would have been 10,000 times 0.03, 3 times 3, which is exactly $900.
So compounding twice a year added an extra $34 and change to the cost.
And that difference, which seems small on a $10,000 loan, gets amplified exponentially when you're financing a multi-million-dollar capital project.
That's the key. That slight but significant difference is why you, as the safety manager, need to be savvy about the terms of the financing, not just the quoted interest rate. Is it compounded annually, monthly, daily? That detail can swing the total project cost by tens of thousands of dollars on a major life safety system.
This segment clearly established the cost side of the equation, the cost of borrowing. But safety managers aren't just borrowing. They're also looking for ways to generate savings and prove long-term value. We need to flip this script. So now we move to the value of money when it's invested or saved. This is the cornerstone of how you calculate the long-term benefit of a preventative program or justify replacing an aging asset. We want to know what the money we save or invest today will be worth tomorrow.
And this brings us to the future value of money concept. We essentially use that same compounding idea, money generating money, and we apply it to investments. Or, in the safety context, we apply it to avoided costs that are saved and reinvested.
Okay.
The formula provided in the standard exam format, which usually assumes annual compounding for simplicity, is F equals P times, in parentheses 1 plus I, to the power of N.
Again, F is future value, P is present value, the capital you have now, I is the annual interest or expected return, and N is the number of years.
So let's look at a direct comparison to really emphasize the power of investment. We just saw that borrowing $10,000 at 3% compounded semi-annually for 3 years cost the company $10,934.
Right. So now, what if we invest that same $10,000 at 3% for 3 years, assuming annual compounding for this formula? What do we gain?
The calculation becomes F equals $10,000 times 1 plus 0.03 to the 3rd power.
Which results in a future value of $10,927.27. Our gain is $927.27 in interest.
And notice how close the cost of borrowing and the value of investing are. It just reinforces that concept of opportunity cost. If the company delays a $10,000 safety investment for 3 years, and that money could have been earning 3%, they've essentially foregone almost $1,000 in profit.
Money sitting idle or tied up in an inefficient system is money that isn't working for the company. It's costing them potential returns.
That's a crucial point. Money not spent wisely on prevention is potentially generating a negative return, both in terms of opportunity cost and, of course, potential injury cost.
So to really drive home the dramatic effect of time and interest, the source gives a long-term asset appreciation example.
Right. Imagine company XYZ buys attractive land, maybe for future expansion or liability mitigation. They buy it for $182,000. Now, if we calculate its value in 20 years, assuming a 9% annual percentage rate of appreciation.
20 years. I mean, that's a full generation in business. The calculation is F equals $182,000 times 1 plus 0.09 to the 20th power.
And the result is, well, it's staggering. The value has transformed from $182,000 to over $1 million.
$1,020,002 to be exact.
It just demonstrates that powerful exponential effect of time and interest working together.
Okay, I have to challenge this, though, because safety managers are not typically investing in land. Our assets, new machinery, safety robotics, advanced training systems, they typically depreciate, often rapidly. How does that change the future worth calculation? Does the source material address that?
That is an excellent strategic question. And while the land example uses appreciation to show the raw power of compounding, you are absolutely right. Safety equipment depreciates. So when you're justifying a safety expenditure, you must factor the depreciation cost of the new asset into the total cost of ownership.
Okay.
But at the same time, you factor in the appreciation of the avoided injury cost.
So you have two things moving in opposite directions.
Exactly. If a new $100,000 machine guard system prevents $20,000 in annual injuries, the future value of that $20,000 in savings grows, but the $100,000 guard system itself shrinks in value due to wear and tear. Your job as the manager is to show that the net benefit, the future value of savings minus the depreciation, is still a massive win for the company over the life of that asset.
That reframes the justification entirely. It's not just about the upfront cost. It's about the full lifecycle financial profile of the asset versus the full lifecycle financial profile of the savings it generates.
Precisely. Now, let's introduce the reality check. Most capital projects are not paid off in one lump sum after years of accruing interest. They involve amortization schedules and installment payments.
The sources provide a detailed loan balance formula for this, and they note it's complex and not usually required on exams. But conceptually, it shows how complex real-world financing gets when you're making regular payments.
Yeah, the full formula is a bit of a monster. It accounts for the original loan, the number of payments, the rate, the payment amount, all to determine the remaining balance at any point in time.
Let's just focus on the conceptual result from the example they give. A company borrows $10,000. They agree to make equal payments of $100 monthly, and the APR is 4%. What's the remaining balance after 3 years?
So after plugging all those values into the full amortization formula, the final remaining balance is, well, it's surprising.
Even though they've been paying $100 every single month for 3 years, the balance is still $7,340.
And this result is a crucial insight for you when you're communicating with operational leadership. While a monthly payment of $100 seems negligible.
Right. It's a small operational cost.
But 3 years later, the company has paid $3,600, yet they still owe over $7,000. It highlights why the payment structure matters. You have to understand the true burden of the amortization schedule.
Now we get to it. The absolute core application of engineering economics for our audience, the safety ROI calculation. We use the time value of money, specifically present worth, to determine the payback period, the time it takes for a safety investment to pay for itself through avoided injury costs.
This is the definitive metric for proving financial benefit. We use the present worth formula, which is P equals F times 1 plus I to the negative N power. This formula calculates the present worth P of a future savings F that you receive in years from now, discounted by an interest rate I.
And the crucial variable here is I. This isn't necessarily the interest rate of a loan. It represents the company's internal rate of return, or the opportunity cost. If the company has a hurdle rate of, say, 12%, meaning they expect a 12% return on all their investments, then I is 12%.
And that's a penalty we apply to future savings. We have to discount that future $10,000 saving because that money could have been earning 12% if it were available today.
Exactly. So let's tackle the high-stakes scenario from the sources, the payback period. XYZ Corporation invests $30,000 in new safety equipment. They predict this equipment will prevent $10,000 in injury-related costs annually, indefinitely. The company's opportunity cost, that interest rate, is 12%. The question is, when does that $30,000 investment truly pay for itself?
Now, if you ignore the time value of money, the answer seems simple. $30,000 divided by $10,000 in savings.
3 years. That's the misleading, wrong answer that finance will reject.
Because that future saving of $10,000 only comes at the end of each year. We have to calculate the present worth of that future saving year by year, and then add them up until the total exceeds the original $30,000 investment.
Okay, let's step through this year by year slowly, because this calculation is the centerpiece of the ROI argument.
Let's do it.
Starting with year one. The $10,000 in savings you get 1 year from now has to be discounted by 12%.
So P equals $10,000 times 1 plus 0.12 to the negative 1 power.
The present worth of year one savings is $8,928.57.
Okay, so after year one, the $30,000 investment has been offset by that amount. We subtract it, and we have a balance remaining of $21,071 and change. We are not paid off yet.
Not even close. Moving to year two. That $10,000 saving is 2 years away, so it gets discounted more heavily.
Right, the opportunity cost has had longer to act on it. So P equals 10,000 times 1 plus 0.12 to the negative 2 power.
Which gives us a present worth for year 2 savings of $7,971.94.
We add that to the year 1 value. The cumulative present worth of our savings after 2 years is now $16,900.51.
So we are still substantially short of the $30,000 we need. That 12% hurdle rate is really slowing down the repayment.
It is. So we continue to year 3. The discount factor increases again. P equals 10,000 times 1 plus 0.12 to the negative 3.
The present worth of year 3 savings is $7,117.80.
The cumulative value now reaches $24,018.31.
Now think about this. If you, the safety manager, had just used that simple math and promised a 3-year payback, you would have missed the mark by almost $6,000 in present value terms.
This is why that discount rate is a deal breaker.
So we have to go to year 4 to close the gap.
We do. P equals 10,000 times 1 plus 0.12 to the negative 4 power. The present worth of year 4 savings is $6,355.18.
And finally, the cumulative value at the end of year 4 is $24,018 plus that $6,355. Which totals $30,373.49.
So we've done it. The original investment of $30,000 has been paid for, with a slight surplus.
And the key, undisputed takeaway is that the safety investment requires almost 4 years for the avoided injury costs to pay for the initial capital expense when you correctly account for that 12% cost of capital.
That difference, 3 years versus almost 4 years, is the difference between winning and losing the project approval.
This specific annual calculation empowers you to manage expectations, define success in financial terms, and align the budget cycle accurately. When you can present this level of rigor, you instantly move the safety discussion from the subjective to the quantitative.
You've provided a factual, calculated payback period that the finance department can actually trust.
That detailed payback analysis was extremely clarifying. It shows the power of money over time, whether that money is being borrowed or being saved. Now let's shift focus to justifying those massive long-term capital investments that involve regular, equal cash flows, also known as a series or an annuity.
Right. We need to understand how money moves in these periodic streams, because safety often involves regular outlays like preventative maintenance budgets or insurance premiums, or regular receipts like sustained annual savings.
Let's start with finding the future value of a series of payments. For this, we use this series compound amount factor. This factor is used when you want to find the future value, F, of a series of regular equal payments, A.
Think of this as funding a future liability. Perhaps you know an expensive piece of safety automation, like a robotic welding cell or a complex fire suppressant server, will need to be replaced in 5 years at a cost of $50,000. You start putting money aside annually. How much will that accumulated fund be worth?
The formula provided is F equals A times, and then a fraction. 1 plus I to the n minus 1, all over I.
Let's run a simple example. You decide to set aside $100 in equal annual payments at the end of each year. The fund earns 8% annual interest, and you do this for 3 years.
Okay, so we want to know the future value of that stream of payments. We insert A equals 100, I is 0.08, and N is 3.
Right. F equals 100 times the result of that fraction. If we calculate the factor inside the brackets, the series compound amount factor, it comes out to about 3.246.
We multiply that by the annual payment of $100.
And the future value of that stream of 3 $100 payments, after accounting for the 8% interest earned on the previous deposits, is exactly $324.64.
This factor is vital for calculating how much savings accumulate over time or for funding a future known liability. It lets you track the value of internal reserves you've set aside.
And it ensures that cash is available when you need it.
That makes the next factor, the sinking fund factor, immediately intuitive because it's the exact inverse. Instead of finding the future value from a known payment, we determine the necessary payment amount, A, that's required to reach a specific future value, F.
Right. The sinking fund is what you use when you know the future cost. say, that equipment replacement, and you need to calculate what you need to set aside annually to hit that target.
The formula for the sinking fund factor is A equals F times the inverse of the last fraction. So I over 1 plus I to the n minus 1.
Let's use the safety vehicle example from the source. You determine that you will need a future value of $10,285 in 3 years to buy new specialized safety vehicles. The internal investment fund earns 7.5% annually. What equal annual payment A do you need to make to hit that target?
Okay, so A equals 10,285 times that fraction. The factor in the bracket, the sinking fund factor itself, comes out to roughly 0.306.
So the required annual payment is A equals 10,285 times that factor,
which results in a required annual payment of $3,147 per year. This allows you to set aside the appropriate operational funds now, avoiding a cash crisis when the replacement is due.
And now we transition to arguably the most critical and complex calculation for our audience, the capital recovery factor, or CRF.
If the sinking fund is about saving up,
the capital recovery factor is about paying off.
This factor determines the period payment, A, based on the present worth, P, of the loan. This is exactly how the largest safety projects are financed over a fixed period.
The CRF translates a huge upfront cost into manageable, predictable annual budget lines.
Okay, so the formula is key for justifying a major capital investment. It's A equals P times. Another complex fraction.
Yes, it's I times 1 plus I to the n, all over 1 plus I to the n minus 1.
A is the annual payment we need to find. P is the present worth, the total amount borrowed. I is the interest rate, and N is the number of payment periods.
We have to look at the highly detailed, complex example from the source material for a major life safety upgrade project. This demonstrates precisely the level of rigor a safety manager must employ to get approval for multi-million-dollar mandates.
Okay, let's set the stage. The engineering team estimates the total cost of the life safety and NFPA code upgrades to be a substantial $5,350,800. The company has $640,000 in immediate internal funds available. The remaining loan will be financed at 6.375% annual interest over a 10-year term.
Right, step 1. Determine the actual funding required. That's the present worth, P, of the loan itself.
$5.35 million minus the $640,000 the company has.
That equals $4,710,800. That's the funding required from the lender.
Okay, step 2. Account for financing fees. This is the detail that separates a good proposal from a rejected one.
Yes, the source mentions a crucial detail. There is a 2.5% loan origination fee of the total loan amount that will also be financed.
Wait, so the fee gets rolled into the loan?
It does. The origination fee is 0.025 times that $4.7 million, which is $117,770. We must add that fee to the required funding because it increases the principal of the loan. So the total amount borrowed, the present worth, P, for our formula, is $4,828,570.
Wow. This step is critical. You're not just asking for the equipment cost, you're asking for the equipment cost plus the hidden financing costs. By including that fee, you're being totally transparent about the true debt burden.
Now we plug this massive p-value into the capital recovery factor formula, with I being 0.06375 and n being 10.
This is a complex calculation. I mean, that term 1 plus I to the 10th power is roughly 1.855. You have to calculate the top and bottom of that fraction separately.
When you run those complex numbers, the capital recovery factor itself, that entire bracketed term, comes out to approximately 0.1384.
The final step. Multiply the total present debt by that factor. The final calculation for the equal annual payment, A, is $4,828,570 times 0.1384.
Which results in an annual payment of exactly $666,342.66 per year for 10 years.
And that is the strategic power of engineering economics for the safety professional.
You started with a vague, massive code mandate of over $5 million, and you finished by presenting the exact, predictable, undeniable annual cost, $666,000 and change.
That's amazing. It takes a conceptual safety necessity and translates it into a fixed budgeted line item. When you can present this exact number, you take the project out of the realm of opinion and put it into the realm of budgeted, predictable cost.
That level of rigor is what earns trust and approval in the C-suite, especially when dealing with mandatory compliance projects.
Okay, so to fully understand how that payment works, we conclude with the series present worth factor. This is the inverse of the capital recovery factor.
Right. It helps us determine how much of a series of payments, A, accounts for the present value, P, of the loan. It separates the actual capital repayment from the interest payments.
So the formula is P equals A times another fraction.
Let's use the context of our massive capital project to see how much of the debt is covered by the payment stream. Let's assume, hypothetically, the company makes $500,000 annual payments over 10 years at a very low interest rate of 0.575%. How much of that total repayment accounts for the present worth of the loan?
Okay, so we plug in A equals 500,000, I is 0.00575, and N is 10.
The complex calculation inside the bracket, the series present worth factor, comes out to about 7.49.
And the source calculation gives us a present worth of the repayment totaling $3,745,000.
Now, compare this to the total loan amount from our big CapEx example, which is over $4.8 million. This calculation shows that of the total payments made over the 10 years, about $3.7 million went toward covering the initial present worth of the capital itself.
And that remaining difference, about $1.1 million.
That remaining difference, about $1,083,570, is essentially the cost of the interest and fees over the life of the loan. Understanding this factor is vital for budget forecasting because it clearly separates the cost of the asset from the cost of financing it over time. It gives the business a transparent view of its debt obligations and capital expenditures.
Which allows you, the safety manager, to be an effective partner in financial planning, ensuring the budget accurately reflects both principal and interest expense.
If we connect all this back to the bigger picture, it's clear that engineering economics is not some niche topic for safety professionals anymore. It is rapidly becoming an increasing factor in their day-to-day strategic operations.
We've seen that, financial planners are the ones who handle the really nuanced structuring of complex loans.
But the safety manager still needs this foundational information, simple and compound interest, present worth, and especially that capital recovery factor, to credibly justify their recommendations to executive leadership. You must move beyond solely ethical arguments. You have to speak the quantitative language of investment.
Right. A well-thought-out recommendation that's backed by solid financial calculations, like that accurate 4-year payback period that factored in the 12% opportunity cost, or the exact annual capital recovery cost of a major upgrade, is always received in a far more favorable light by the final decision makers.
It shows professionalism, financial acumen, and it proves that you view your role not as a regulator, but as an investment opportunity generator for the business.
Okay, so let's unpack this final critical thought.
Yeah.
We spent a lot of time on that capital recovery factor because the source material specifically says it's key for massive projects like life safety and NFPA code upgrades. This is where the intersection of safety compliance and finance gets incredibly sharp.
Indeed. We started by calculating how long it takes for a safety investment to pay for itself in avoided injury costs. That's the classic proactive ROI model investing to generate savings.
But if a project is mandated by law like that multi-million-dollar NFPA code upgrade, the calculus changes fundamentally, doesn't it? How does the capital recovery factor change the financial justification in that scenario? Do we still calculate the safety return based on avoided accidents, or does the cost of non-compliance become the ultimate financial driver?
The potential for massive regulatory fines, crippling lawsuits, operational shutdown, and catastrophic reputational damage. When a project is mandatory, the safety manager is no longer calculating an ROI based on a potential gain. They are calculating the cost of necessary financial insurance against failure. The capital recovery factor provides the predictable, exact annual cost of meeting that legal insurance requirement.
So here's something critical for you to mull over as you justify your next safety initiative. Is the capital request fundamentally an investment against future injuries, which offers a calculated return over time? Or is it mandatory insurance against catastrophic financial and legal failure? The answer might completely change whether you focus your pitch on the payback period or on the undeniable fixed annual cost derived from that capital recovery factor. Which financial model will your executive team respond to most favorably? That is your strategic choice.